What's going on, guys? Welcome to Module 2. This is about pulling and analyzing your credit reports. So, the objectives that we're going to go over is identifying every negative item and risk factor before disputing anything. So, we're going to go over where to pull your reports, what to look for, and building a credit audit worksheet. So, where to pull your credit reports? Before you start this process, right, you need to understand that you have to get your complete three bureau credit report. Credit Karma is not going to work. Reviewing all three reports is critical because lenders may report information to one bureau, but not to the others. And the most commonly used platforms where you can get your credit reports from are places like Identity IQ, Smart Credit, MyFICO, and what we like to recommend for our clients and for you guys, annualcreditreport.com. And I'll explain why that is. Right. So annualcreditreport.com is basically the most cost effective because it's free and you can get a free credit report every week and you're going to get your actual credit reports, right? So annualcreditreport.com is the official website authorized by the federal law for consumers to obtain their credit reports directly from the three major credit bureaus. And why this platform is important is because this service provides the actual credit bureau reports exactly as maintained by the credit bureaus themselves. Unlike monitoring services like My Free Score Now, Identity IQ, Smart Credit, My Score IQ, these reports are reformatted or interpreted versions of your credit report. So they're not legally binding on the actual credit bureaus, which is very important in this credit repair process. Recommended workflow for you is step one, of course, pull the official credit reports from annualcreditreport.com and make sure you download them as PDF copies. The next step is to review each credit report carefully and identify any personal information errors, negative accounts like collections, charge-offs, repossessions, hard inquiries, incorrect balances, incorrect dates, et cetera, et cetera. Right. And step three is you want to use the monitoring tools like Identity IQ or Smart Credit for any ongoing tracking if you want. So, what to look for when reviewing your credit report? Once you obtain the three credit reports, the next step is conducting a complete audit. Right. This process involves reviewing every section of the report to identify items that might be inaccurate, incomplete, outdated, or just negatively affecting your credit score. Right. You want to carefully identify these items in order to allow you to determine which account should be disputed, corrected, or addressed through credit optimization strategies. So let's look at the primary categories that you should review when auditing your actual credit report. Personal information errors, right? So the personal information section on your credit report contains the identifying data that's used to match your credit accounts to you as a consumer. And what you should review is this section for inaccuracies. So some of the common inaccuracies or personal information errors are incorrect name variations, old addresses that no longer belong to you, incorrect phone numbers, emails, incorrect employers, etc. And incorrect personal information, the reason why we want to fix this is because it signals to lenders that you are high risk, right? And you may indicate fraud. So multiple names looks like you use different names when you apply. Multiple addresses means it's probably going to be hard for a lender to find you if you do default. And then multiple employers signify instability in income. So when it comes to collections accounts, now collections appear when a creditor transfers or sells that debt to a third party collection agency. And these accounts typically occur after a payment becomes seriously delinquent. Common types of collections are for credit cards, medical debt, utilities, telecommunications like a cell phone bill, or even evictions. Collections accounts can significantly affect your credit score. The things that you need to review on collections accounts are things like incorrect balances, incorrect account ownership, duplicate collection reporting, and other types of inaccuracies that you can find on that particular account. One thing I will say about collections too is we want to leverage again, like we reviewed already, the FDCPA, the Fair Debt Collection Practices Act, and the debt validation method. So for charge-offs, right, a charge-off occurs when a creditor determines that the debt is unlikely to be repaid and they write it off as a loss for accounting purposes. However, this does not eliminate your obligation to repay the debt. I know a lot of people talk about the 1099 and if they charged it off, you don't know, you no longer owe it. That's not true. How charge-offs affect your credit is charge-offs are considered major negative events in credit scoring models. They often remain on your credit report for several years, and they may continue updating if balances are unpaid. And what you should review on a charge off account is things like incorrect balances, incorrect payment history, incorrect reporting dates, and other information that you can find to be incorrect on that particular type of account as it's reported. The next category is late payments. And late payments occur when you fail to make the required payment after the due date. Credit reports, they typically categorize late payments based on length of delinquency. So common late payment categories are one billing cycle past due, meaning 30 days, two billing cycles past due, meaning 60 days. A serious delinquency is considered 90 days out, and very severe is 120 days out. After about 180 days, they will charge off that account. So recent late payments typically have a greater impact on your score than older ones. This is why some lenders will look past the late payment that was, say, 12, 18, or 24 months old, and you can still qualify for funding, right? But when it comes to these, you need to verify whether reported late payments actually reflect your actual payment history. Because if you didn't pay 30 days late, right, and you say you paid 15, you shouldn't have a 30-day late payment on your credit report, if that makes sense. Now, when it comes to repossessions occur when a lender takes back collateral that's used to secure the loan, typically like vehicles. This usually happens after extended periods of missed payments. How repossessions appear on your credit reports is they may appear as repossession entries. They also may appear as charge-off accounts with repossession notes or deficiency balances remaining after a vehicle sale. So when it comes to repossessions, you need to verify whether the balance is reported correctly, the dates of delinquency are reported correctly, and the account status descriptions. Because again, if it says charged off, but it doesn't have any notes of repossession, it's technically not accurate. So when it comes to evictions, right, and like I said, telecom, medical debt, and stuff like that, they may appear on your credit report if they are reported through certain tenant screening services or public record reporting agencies like LexisNexis, for example, or Pacer. These entries indicate that a landlord obtained a court order to remove that tenant from the property. And evictions, they may affect your ability to rent housing or qualify for other financial services. So you should review eviction entries for accuracy and ensure that the reported court information is correct. So when it comes to medical debt, this is a common source of collection accounts that's being reported, and they arise from things like hospital bills, doctor visits, emergency services, insurance billing errors, and things like that. Medical collections sometimes appear after disputes between either the healthcare provider and or the insurance companies. And you want to review medical collections carefully for billing errors, which are relatively common in the system for healthcare. Now, when it comes to hard inquiries, these appear when a lender reviews your consumer credit report during a lending decision. Soft pulls, they don't negatively affect your credit, and they must have permissible purpose for hard inquiries. This is found under Section 604A3 of the Fair Credit Reporting Act. And some common reasons for hard inquiries include credit card applications, loan applications, or auto financing requests. Now, hard inquiries generally remain on your credit report for up to 2 years, but they can be removed within 24 hours using the right script if you call. And you only want to challenge inquiries that are not connected to open accounts. You don't want to challenge inquiries that's connected to open accounts for obvious reasons. So why hard inquiries matter is because multiple inquiries within a short period of time signal increased borrowing activity, which some lenders view as higher risk. And this is why if you have poor credit, you shouldn't be applying for new credit until you've repaired and optimized your credit profile properly, right? So when it comes to inquiries, you want to identify, do you recognize it? Was it authorized by you? Or was it resulting from a mistaken credit pool? Now, when it comes to bankruptcies, a bankruptcy is basically just a legal process that allows you as a consumer to restructure or eliminate certain types of debt under federal law. And it's often reported through a company called LexisNexis and Pacer, which is the public access to court electronic records. And the common types are Chapter 7 bankruptcies and Chapter 13s. And bankruptcy filings typically appear in public records section of your credit report, with accounts also that are included in the bankruptcy too. Those will be on your credit report too. Now, bankruptcy impact on your credit. Bankruptcies are probably the worst thing that can happen to your credit, right? It's considered one of the most major credit events and can definitely affect your profile for several years. However, their impact typically diminishes over time as positive credit behavior is established. But it's an automatic denial though when it comes to like 0% interest APR cards and certain other types of funding with certain lenders, right? It'd just be like having too many inquiries as well. That's like another automatic denial. So when it comes to verifying bankruptcy records, you want to make sure that the filing dates are correct, that they have the correct case numbers, that there's accurate court information, and you also might want to dispute it with LexisNexis, get it removed from them. You want to use your PACER report to be able to kind of find anything that's reporting in violation, and then you could go back to the credit bureaus and try to remove it that way because they won't be able to verify it after that point in time. So the key takeaway is just a proper credit audit requires you to review every section of your credit report and identify those items that may be negatively affecting your credit profile, right? You want to carefully examine, again, personal information errors, collections, charge-offs, late payments, repos, evictions, medical debts, bankruptcies, hard inquiries, anything that's negatively affecting your credit profile at that point in time, right? And then we'll talk about later on in the course how to start optimizing, because that's like the second phase of the credit repair process. But once these items are identified, then you can determine the appropriate strategy for correcting the inaccurate information or improving your credit profile, as you move forward. And again, we'll get into some techniques, some methods, and things of that nature, AI tools that can help you effectively remove these negative items off your credit report, and the dispute flow, right? How you should be disputing month to month to get optimal results.